Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. AT&T and Verizon stocks dividend yield looks super juicy right now. Both are yielding above 7%. And if you're looking for a stable stock to get you paid, there's a good chance that these two stocks are on your list to buy. Not so fast, friends. There's a little bit of a flaw for both of these companies that have absolutely not delivered for investors for a very, very long time. I'm Jason Hall. This is The Smattering. Got Tyler Crow on here with me, and we're going to talk about why that is the case. Hey, Tyler.
How's it going, Jason? I always find telecommunication companies slightly fascinating because they don't deliver what you would expect them to. And we can get into that.
It's so true, and it's so frustrating because you think both of these companies, they have their massive wireless networks. They have pretty high customer loyalty. They've proven that they can get pretty good margins by charging a premium. And both have some other assets as well besides those wireless networks. They have their large telecommunications, land-based networks, fiber optics, other ways to generate revenue that should result in a business that's able to grow modestly, get good margins, grow their profits faster than revenues, pay a good dividend, grow that dividend over time, and deliver returns that should make them really attractive for people that want to be able to grow their income over time. That's not the case. What's wrong? What's the flaw here that's limited these two companies in terms of their ability to deliver for investors?
First, we're going to take that little problem of deciding to want to be media companies, I don't know, in the early 2010, buying up media properties. We're just going to throw that one to the side and just pretend that one doesn't exist because that was a big one. But that's not what we're talking about here. That was a huge waste of capital, but that's not what we're talking about here.
That's not unique. I'm going to talk about that for a second now because it is important, because what Tyler's talking about, especially AT&T, but Verizon to a lesser extent, both spent substantial money outside of telecommunications. Well, I guess technically it is still telecommunications, but more on the entertainment side to acquire studios, cable networks, entertainment properties, websites. Like Verizon bought a bunch of things that they overpaid for
AOL.
that did not deliver. AOL, right? Things like that just did not provide economic benefit. And while there was a little bit of overlap, they were well outside of what those companies really should do really well, what their managements know really well, what their experience is. But every company does that. Companies get profitable, they do really well, and then management, they're compensated to grow the business, and then they go buy something dumb that doesn't work, right? That's not what we're talking about. But I think it's important to say that, yes, those things did destroy a lot of capital, but let's get right to the core of the thing that kind of undermines these companies' ability to deliver over the long term.
Yeah.
Maybe even more important, because it is like, it's the core of what they do.
When we think of telecommunications, like these companies, and especially their wireless business, we think infrastructure, right? These are infrastructure plays that connects all of our devices and things like that. And typically infrastructure companies are toll booth type companies that can basically milk these assets for years and years and years. And, they just keep spitting out cash. The technical problem is with telecommunications companies is those assets are so much shorter lived than what you have in your other typical infrastructure investments, like a toll road, pipeline, hydroelectric dam. Those things last for decades. And with marginal, minimal maintenance capital, you can keep those things running for decades and they'll just spew out cash for you. Because we have moved so quickly on the development of wireless protocols, these have been relatively short windows that this asset has been monetizable. If you look at how long we had with each of these, it's been about maybe 5 to 7 years where you could really, really milk those deployed assets for cash. That's not a long time in the infrastructure industry. And the amount of money that you have to deploy, if you look at the capital allocation or the CapEx for these companies, it is in the tens of billions of dollars each year, even more so. And because of that and the rapid turnover that you have in these assets, it makes it that much harder to be profitable over the long term because you're just on this treadmill of massive capital spending that you can't milk for cash for a really long time.
To put some numbers behind that, Tyler, AT&T spent over the past 4 quarters about $19 billion on on CapEx. Now, of course, some of that is maintenance CapEx, and about $26 billion for Verizon. So these are substantial amounts of money that go above and beyond just maintaining their networks. It's having to continue to invest. These are not creating a competitive advantage investments that it allows these companies to generate higher margin. Tyler, AT&T has to spend the money to keep up with Verizon and to keep up with T-Mobile. And Verizon has to spend the money to keep up with T-Mobile and to keep up with AT&T. It is that arms race simply to remain competitive.
That just means you're plowing billions in perpetuity into these telecommunications network that generates marginal shareholder value.
I want to put one more number behind it to kind of support why it's so overwhelmingly clear that it's going to be a real struggle for these businesses to deliver great economic returns for investors. Again, you think about these are legacy names that have been around for a long time. It seems like I can buy these, they're going to be safe and they're worth owning. Over the past 10 years, the S&P 500 has generated 208% in total return. So that's gain in value of the stocks plus the dividends that are paid by those companies. Again, 208%. Over that same period of time, AT&T has delivered 23.4% in total returns. Again, 23.4 compared to 208. Verizon, 13.3% in total returns. So a lot of that, yes, is value destruction by really dumb investments of things that didn't fit within the business that destroyed billions of dollars in value. But that's just a part of it. I really want to caution investors from looking at these stocks and saying, hey, these are worth going after because that yield. If you want to find some good stock ideas, please go to our special link, fool.com/thesmattering, put in some information, and you could probably find some better stocks to buy right now.